everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. I followed his work for years. He wrote a very popular book. It's called Greenspan's Bubbles, The Age of Ignorance at the Federal Reserve. He's a successful hedge fund manager for a long time, and he also has a paid newsletter. Thank you for joining us on a Wall Street for Main Street podcast, Bill Fleckenstein.
Thanks for having me.
Now, Bill, in terms of the macroeconomic situation, we have Europe doing their version of quantitative easing. Their banks are basically insolvent. They're even more leveraged, I guess, than U.S. banks at this point. They're pulling off bad assets. Do you think this is just a game of, currency wars where Japan and Europe are all trying to devalue their currency to gain some type of export advantage?
Well, I don't think it's just that, but they are certainly trying to devalue their currencies, right? I mean, that is the name of the game. No one wants a strong currency, including the United States. So at some point, I figure somebody will start paying lip service about how this isn't good for us either. But for right now, no one seems too concerned about that.
Now, in terms of your book about Greenspan's bubbles, we have asset I think you'll agree with me that most of the inflation that's been created globally, and there's all these global quantitative easing programs, there's been currency swaps that have humongous lack of transparency. It just seems to me that the stock market's in a bubble. The real estate market has come back a lot faster than many expected. The bond market's going up. It's not you've studied markets longer than I have. You've been in the financial industry longer than I have. Is it normal for stocks, bonds, real estate, all these asset classes to all be going up at once?
Well, it's not necessarily, normal or abnormal. I mean, in the 80s, real estate, stocks, and bond markets all rallied together. So there's nothing inherently wrong with those markets all going in the same direction for a time and being somewhat correlated. The question is, what's the driving cause? Is it happening because economics and the economic world and the financial world, both in America and around the world, are doing well and we're generating growth and profits and things are really going well? Or have these markets been boosted artificially because of a massive amount of money printing? I obviously think it's the latter. I suspect you probably do too. But if that's the case, it means that you cannot necessarily trust the economic statistics because they have a certain degree of hot air in them. It also means that the risks are higher. It means you have to position yourself differently. You have to understand that things could come unstuck and get ugly very quickly. So it's not that those markets have done what they've done. It's the reason behind why they've done what they've done, if that makes sense.
Yeah, that definitely makes sense. And we're not seeing these large corporations, we're not seeing them spend as much money on research and development. A lot of them are not putting as much money in the past as it would have into new capital expenditures, new plants, new equipment, new factories and things like that. We're seeing a lot of these large corporations take advantage of the artificially suppressed interest rates and buy back stock, or we're starting to see a large merger and acquisition boom, a la the leveraged buyout days, the crazy days of the 1980s, with the junk bonds and things like that, especially with these low junk bond yields.
Yeah, I mean, I can't disagree with your description of that.
Now, in terms of the macroeconomic situation going forward, you have a very interesting quote on your website, FleckensteinCapital.com. It's right at the top of your website for our listeners out there who want to check it. It's, in a social democracy with a fiat currency, all roads lead to inflation. So you basically think then that there's almost zero chance that the central planners, these Keynesians, will allow any type of real deflation then throughout the economy on a long-term basis then going forward?
Yeah, I when you can print money and you can make promises and run deficits and finance them, I mean, it's nearly impossible to have deflation. I mean, people have been worried about deflation, aggressively worried about deflation since 2007. It hasn't really happened. It hasn't happened. Yeah, we had a bear market in stocks. Yeah, we had a bear market in real estate. We had a bear market in, junk bonds and lots of things. But there was no deflation. But people are worried about deflation. So many people don't know anything about how the depression came about that you have a lot of people that were
I mean,
people think deflation equals the depression. that deflation was an outcome of the depression. But just because you have deflation does not mean you have a depression. So lower everyday prices, which is deflation is really not bad for anyone. And it's not anything to worry about. And if we have a financial accident, that is just something that is a consequence of these crazy policies. So this whole notion about we have to ward off deflation is just nonsense. Do you know anybody who doesn't want lower prices of everyday goods?
Yeah, I mean, the person on Main Street wants more bang for their buck. They want their purchasing power to increase. They want their dollar to stretch further. It's these Keynesian central planners who don't want that. They want higher prices. They think that leads to wage growth and things like that, and they think that that means the economy is doing well. But, yeah, in terms of deflation, I just don't see the Keynesians be willing to allow that for longer than, in 2008, we had maybe the CPI here in the U.S., which lower prices are a symptom of deflation then, because deflation is a decrease in the money supply. The CPI only dropped for a couple months and it was right back up, and you look at the CPI measurements in Europe and Japan and they haven't dropped. So you see these central bankers, all over the globe talking about the deflation boogeyman, and I just don't really see that much evidence of it. Now, maybe the credit growth is not growing as much as they want, but I just don't see that much evidence of real deflation. It seems to me that there's like stagflation, and they're underreporting it or lying about it or doing whatever formula equations they want to not talk about that.
Exactly. We have stagflation. There's no deflation.
Now, in terms of the stock market, Bill, do you see any interesting value propositions on the long side? Do you think the gold and silver miners, that their P ratios are low? Most value investors don't think they're that good of bargains at this point. They seem to not be able to value gold or silver. Do you think these are good values in the resource stock right now?
Well, you have to believe gold or silver are going to go up to want to own gold or silver miners. So the first place to start with the metals. People don't feel like they need the metals because they feel like the Fed and the central bankers have everything under control, and we're going to have a normal, quote-unquote, normal business recovery and all the things that go with that, so people don't want the metals. When they find out that without QE the stock market is going to tank and maybe the bond market will too, then people will start to question their allegiance to stocks and the central bankers, and there will be more of a demand for gold, I believe. So, and if there's a demand for gold, then I think the miners represent good value as a way to participate in gold. But you have to remember, miners are a derivative of the gold price. So if you're not bullish on the gold price, there's no point in owning any miners. For the time being, they're very, very out of favor, and so the risk reward is probably quite favorable. But it's the only area where I would have any real confidence, because I think in a stock market, if the stock market gets roughed up aggressively, which I expect at some point, I think they will actually do well. And at some point, people are going to see that the Fed is not the solution that they've come to believe that it is. From 2000 to 2001, the stock market and markets basically ignored the Fed, and the same thing happened in 2008. Now they're back believing that these guys know the future, and that'll change too. And when that does, and as that does, the metals will become quite popular again, I believe.
Yeah, in terms of value in the stock market, I just don't see that much value in the general stock market, but the resource stocks, more specifically the gold and silver ones, do. There's a lot of companies there that have trimmed really the last 18 months. Really the last 18 months, there's been a humongously bad cyclical bear market. The miners have had to go through humongous cuts in exploration budgets, in selling general and administrative expenses. There's been a lot of upper management fired. I think long-term this was very good for the industry. They overpaid. You're on the board of directors at Pan American Silver.
No. I haven't been on the board of directors there for the last 4 years or so.
Okay.
But I was for a long time, so I get the point.
Yeah, I mean, there's been a lot of bad acquisitions done in the industry for a number of years, and these things have had to be written off, and the sentiment is just so poor right now. I think it's a good long-term contrarian value investing, but people should dollar cost average in and accumulate a position and not go all in at once. Now we're talking about investment strategies of how to accumulate them. I think people can accumulate these things however they fits their risk profile, but I agree with you that
the area is attractive if you believe the things that you and I are discussing. If you don't believe those things, then the idea doesn't hold much merit for you.
Now, you've been known throughout Wall Street as a very good short seller. You shorted the technology bubble, and you did very well for your investors in your hedge fund. What types of things do you look for in a short? Do you short on valuation?
No.
Do you look? No, you don't. Do you look then for a company then that where their technology is becoming obsolete or they have too much debt on the balance sheet? What types of things do you go through on your shorting checklist?
Well, there's all kinds of those things matter to individual shorts. But it's the bigger question is whether the environment is safe or conducive to winning on the short side. And since we've been in the period of activist central banks, which started in about the mid-'90s with Greenspan, they've made it progressively more difficult for anyone to make money being short. So the first thing is, can I even make money being short? I concluded that was not going to be the case after '08, and I closed my short fund down. Now, so, I think you have to say to yourself, is the Fed, do people believe in the Fed in such a way that the markets really can't go down? That's where we are right now. That's one reason why shorting doesn't work. The stock market's hitting new highs. That's a warning sign in terms of the timeliness of putting out shorts. Individual companies don't really go down on bad news very well, though they might start to, so that's another thing. So there's a whole lot of things that would keep me from being short right now. That's not to say that I couldn't change my mind, from a tactical standpoint, if things start to get real dicey, because I think the market is quite crash prone. As far as individual companies, you have to have companies where there's a perception that the company is positioned better than they actually are, and you have to catch them stumbling to be able to make money. And you can anticipate future problems and make money in a period where it's conducive to being short, but like right now, they can come out and pre-announce, and half the time they don't go down. So it's not so important which companies you're short and why. It's whether or not you're in an environment where it works. And to some degree, it's all one trade. They're either all working or they're not.
That's an interesting idea about shorting. What I've been doing, I've been researching more shorting ideas lately. I haven't actually taken any advantage of this, but I like the macroeconomic idea that the U.S. middle-class consumer is drastically losing their purchasing power. So I start with that macro theme, and then I go top down, and then I go bottom up and look for bad balance sheets. But I think the industry, Bill, that is probably hurting the most, and I see this with the parking lot indicators, is the casual dining restaurants. Restaurants are a high capital-intensive business. Their input costs are going up with higher food prices and things like that, and the U.S. middle-class consumer just doesn't have that much discretionary spending because most of them don't have the assets and have made money and have not made money from the wealth effect from asset price inflation like the top 1% has. So, driving by a lot of casual dining restaurants at lunch and dinner, these parking lots are empty. They're starting to close down a lot of stores like the Olive Garden and Red Lobster and things like that. So I think I don't really anticipate the Federal Reserve or the Congress changing the rules to start bailing out some of these restaurants. So I think that's an interesting shorting idea going forward. But like with the banks and the home builders, like the rules changes, you saw with the accounting rules changes with the banks, so they all wouldn't go under even though they're still technically basically insolvent, right? They're marking their assets to whatever they want. And then the home builders got a tax credit from Congress that basically, they were basically all insolvent.
I don't mean to cut you off. I'm aware of all that, and I think that there are problems in almost every industry. But the problem with shorting right now is it doesn't really work very well. Some of these restaurant stocks have gone down. I like your thesis. I agree with you as a place. I just don't know if it's going to work right now. I mean, we could have had that same conversation 6 months ago. So I just think it's more important for the type of environment you're in, whether or not you're going to be able to make any money on the short side, rather than the specific idea. I mean, okay. I ran a short only portfolio for almost 15 years, and I can tell you that there are just periods where it just doesn't work. It doesn't matter how right you are.
Yeah, I completely agree. It's the markets can stay irrational longer than you can stay solvent, especially if you're using leverage on the short or the long side. Now, in terms of the macroeconomic situation going forward, do you think the developing world is going to experience a lot more problems with inflation and potential defaults than the Japans, the Chinas, the Europe? I mean, the Japans, the U.S.'s, the Europe's going forward first. Do you think the developing world is going to have more problems first?
It's hard to really say. I mean, in the quote unquote developed G7 world, you've got all this central bank monetization of budget deficits. And you'd think the bondholders of Japan and Great Britain and the United States, Europe, Switzerland would revolt against these stupidly low rates because they want to promote inflation north of the coupon, and they want weaker currencies. And yet the bond markets don't seem to care. So the bond markets have got to start revolting against those policies. Whether it'll be worse in the developed world or the developing world, I really can't say, because we don't know exactly what's going to be the cause and when it's going to happen. And if I knew that, I wouldn't know what to do about it, even if I knew what the answer was. Because right now, you can't make any money expressing those viewpoints yet.
Yeah, we just don't have free markets right now. The politicians and the central banks seem to me, Bill, to be moving the goalposts or changing the targets all the time with the rules. So when there should be a viable, good long-term investment or a good short sale like what you're good at, it just seems that they're changing the rules now because of lobbying or crony capitalism or things like that.
Yeah, I don't disagree.
Now, Bill, I just want to thank you again for your time here. Please tell our listeners more about your newsletter and if they're interested in maybe signing up for your newsletter or one of your funds.
Well, it's not really a newsletter; it's a website. I publish a commentary on the market every day, and I answer questions. And it's kind of expensive, though. It costs a whole $10 a month. And the URL is fleckensteincapital.com.
Now, one last question. Update on Mongolia. Do you think you seem to have some business ventures in Mongolia? Do you think that Mongolia, the rules changes with the politicians, do you think they're getting too greedy and they're going to really hurt their economy in the long term, or do you think that things are improving there back again to where it's an investable type of a country?
I think we're moving towards the tail end of the bad news cycle. It looks as though the government and Rio Tinto are going to come to terms over the moving forward with the second phase of OT. And that battle has really kind of caused a sour mood amongst investors. I think and it's hurt the economy and the currency. I think that it looks like that's going to potentially be resolved maybe by the end of September. And if so, foreign direct investment will flow into Mongolia again, and things will be better there. But we have to see. The government has had a tendency to shoot itself in the foot last 2 years or so. Sorry.
Yeah, I remember looking at the website for the Oyu Tolgoi project and seeing that the government was bragging on there that it was going to get about 70% of the revenues from the copper deposit, and that's not exactly a good incentive for private investors to want to put more capital into the country when the government's bragging it's taking that much of the revenues from the mining. Yeah,
well, they made some mistakes. They appear to be changing their mind about the mistakes that they've made, and we'll just have to see if they can put this chapter behind them. Hopefully they will, and it looks like they will, but they haven't done it yet.
Yeah, very good. And it's an underdeveloped country, and it has a lot of exploration potential for natural resources and other types of consumer behavior that lead after the workers there get jobs at mining and other things. So there's a developing consumer class there too.
Right.
Well, thanks again for your time, Bill. I appreciate it. And in the future, I'd like to have you back on. I enjoyed this discussion.
Okay, sure.